You are listening to Lender Lounge with Kevin Kim, a podcast dedicated to helping those in the private lending industry grow, improve, and streamline their business. I'm Kevin Kim, partner at Gerasi LLP, the nation's largest private lending law firm. Join me as we chat with the best and brightest in private lending, who are eager to share their years of wisdom and best practices with lenders, borrowers, brokers, investors, and more. Subscribe to Lender Lounge on your favorite podcast platform and learn more about Gerasi and how we can work with you at gerasilawfirm.com. Check out the episode summary for other valuable resources. Hey guys, welcome to another episode of Lender Lounge. Today, we are not in the computer. We are at our conference, Captivate. We are at the Encore Hotel in Las Vegas, and I'm surrounded by these fine gentlemen who we'll introduce in a second, but I'm super excited to do a live episode here. We very rarely get to do this in person, so it's nice to do this. We are currently getting ready for our Captivate Conference, so please tune in for more about that. When we do live episodes, I like our guests to just introduce themselves to our audience, and we'll start from there, all right? Who wants to go first?
I'm happy to do it.
All right,
someone else is raising their hand. Hi. Evan Stone, been in residential finance really since I got out of college. I don't know anything else, so I don't know much about much, but I do know a reasonable amount about both consumer and business purpose lending in the residential markets. And currently, I'm the CEO of Champions Funding and the chairman of Community Savings, both institutions that specialize in non-agency lending.
Yeah, I mean, I'd say ditto, much like Evan, been in real estate finance my entire professional career, going on 27 years now. I currently serve as the president of Dominion Financial Services Wholesale Group. I joined that group about 2 months ago. We'll probably talk a little bit about what we're building out. Again, focused on investor residential with a tease into some consumer-focused product as well that we'll talk about.
Thanks for having me, Kevin.
Of course.
It's great to be here, and congratulations on your new role. That's really cool. Yeah.
Thank you.
So my name's Dave Orloff. I'm the CEO of American Heritage Lending, and I've been out the mortgage business since 2008, which was sort of a silly time to start that venture. But we do both consumer and business purpose lending, and I certainly enjoy one more than the other.
And that's why we're having this pod today, because ordinarily we do kind of one-on-one interviews, but I've noticed a big trend over the past, let's say 3 years, of folks having 1 foot in the consumer camp and 1 foot in the BPL camp, which I'll call it BPL. Okay. And then there's also been entries from that world into the space, whether they keep 1 foot in or not, but they've new entries. Some of these are pretty sizable companies, have entered the space and really found it to be attractive. And I wanted to make sure that we had this consistent theme today. But otherwise, there's no rules today. We talk about whatever we want. First thing I really want to put out there is, which one do you guys like better? Because consumer is tough. I know very little about consumer. At Gerasi, when we get a phone call, and the guy tells us on the phone, hey, I'm doing owner-occupied, like, oh, pump the brakes, right? Because Gerasi doesn't touch owner-occupied. We don't touch consumer. We just do BPL. The only thing that we do is a little bit of licensing here and there, but that's as far as it goes. We always send it out to our friends out there. But like on the operator side, I got to ask first, which one do you like better? Because it's an interesting perspective you guys have that is unique. So,
Yeah, I'll go first. I historically have been in consumer facing business. I think both have a unique delivery to the customer. I think the customer they serve is slightly different. BPL lending serves a need for those that can't qualify necessarily for traditional financing, or traditional financing doesn't make sense for them. It's more predicated on the cash flow of the property itself, which is kind of more akin to a commercial transaction. Consumer facing, I think, serves a need of just, I'd say, more traditional home ownership, the idea of achieving the American dream of owning a home. So I think each serve a unique blend of customer. But I think if I had a preference, I'd say, just because I've been doing it for so much longer, probably consumer facing.
it's what you know.
It's what I know.
Yeah.
Certainly, the business purpose loans, less compliance. Not that there's no compliance, but it's a little easier from a compliance perspective. Generally speaking, a little easier from an underwriting perspective too, because you're not underwriting personal income.
Right.
I mean, that all said, I mean, I can only really speak for our organization. I mean, I think we're really indifferent. I mean, at the end of the day, we kind of think of non-QM and DSCR as being all part of kind of the non-agency ecosystem. And so, we don't want to be everything to everyone. So we're not offering agency govy loans, but within the non-agency part of the lending market, we want to have a meaningful wallet share across the spectrum. So that means serving investors that want to buy investment properties, perhaps using DSCR and cash flow from the subject property, and then certainly those that want to be homeowners, first-time home buyers on the consumer side. And as a U.S. Treasury, CDFI, Community Development Financial Institution, most of what we do is consumer, but certainly on the investment property side of the house, we see with our target markets, underserved people that just like anyone else want to get ahead in life, and they don't trust the stock market, they don't trust other investment possibilities out there. What they trust is real estate, right. And so they build wealth through real estate ownership. And so from that perspective, we're serving ITIN borrowers that want to buy investment properties, foreign nationals. And so that's what's really meaningful for us, whether they want to build wealth through buying a home that they're going to live in, or whether they're building wealth because now they're at a point in their trajectory where they can buy an investment property. We're indifferent, so I know it's kind of a boring answer. Kevin, I wouldn't say I prefer one over the other.
But you're serving a need, which is important, right?
That's the idea.
Right.
Yeah.
I know you like one better than the other.
Make no bones about it.
Yeah.
So, we started in 2008, probably ground zero for the worst time to be in lending, period. And I think consumer, you're riding the sine curve of the interest rate cycle. And if you're consumer direct and you're spending money to help your loan officers in marketing and what have you, I found that you scale businesses, if you're looking to build a business, just to have it kind of torn down by stuff that's outside your control. And then I also find that I struggled with what I call the real commoditization of the product, right? It all rolls into a GSE. Evan's got some unique products that he's able to offer under this new bank structure, but I love the business purpose lending space, and I love it for the creativity that it's not a bunch of people kind of hitting AUS until they find an approved eligible. In BPL, you're really offered a chance and a premium for your creativity, for a deep credit background of saying, I kind of understand a borrower. I understand a piece of real estate. I understand credit. I know how to read trade lines and depth of credit and things that are different because of my consumer background. Mm-hmm. But boy, oh boy. And not just because of the compliance ease, it's just to be creative again and differentiate and build products. Mm-hmm. BPL right for me. So
let's kind of get into the weeds of your respective businesses. I want to know more about the company, like details about how you're operating, what products you're offering, but also how are you capitalized as it pertains to BPL in comparison to we'll call it consumer, right? Because there has to be differences, right? So give me some more color about the businesses, and we'll go from there.
So when we got into, leaving 10 years of agency to come into BPL and having lots of talks with you at Innovate in Newport Beach, we were shocked how little liquidity of secondary markets really existed.
When was this again? What year was this?
That was 2018.
Right.
18, 19.
It still wasn't quite there yet. Yeah.
Right. And so, you're so used to whatever delivery mechanism you go, correspondent, wholesale, whatever it is in agency, you really have a plethora of takeouts, especially if you've hit AUS and you have an eligible, so you don't really sweat funding a loan and then not having a home. But boy, oh boy, that's not the same in BPL. So really quickly, we were nervous enough that, and I think a lot of consumers coming into our business are using traditional warehouse lines and other products to fund loans. We realized with PGs and all the crazy stuff that's attached to the consumer side, we were sort of playing with fire, and we went out and we did a joint venture with a big REIT. So,
Right.
and I think it's fair to say that REIT's Ellington here.
Right.
So we, for specifically the RTL and business purpose stuff, partnered there in a meaningful way such that we would have a backstop
Right.
for liquidity.
Now, that's changed a lot since 18, right? And you guys were one of the early ventures into that. Like we saw that iteration happen over and over, and other aggregators and institutional investors start adding to the book of business. And it's certainly evolved in that short time span, 3 years, 4 years, now 5 years. Wow, how far we've come. But what's interesting is the commoditization starting to, we're seeing it in our side too. Not compared to, nowhere near compared to conventional.
I
But
agree.
we're seeing it. And it's been kind of like, oh boy, I don't know if I like this anymore, So, but give me more color on your guys' business and let's chat about this stuff. Yeah.
No, I agreed, right? So, I mean, you take the agency piece out of it where you don't have the easy button lending and kind of that guaranteed liquidity
Right.
with the two GSEs. I mean, the calculus of risk is completely different,
Right.
So at Dominion, we are fortunate. We've got some substantial partnerships with a couple of large life co companies, life insurance companies. Currently, through a myriad of vehicles, purchase about 50% of the paper originated in non-QM today. And they really are the principal provider of liquidity in that non-QM space, whether the non-QM space is focused in consumer help through bank statement product and asset depletion product, or through the BPL with DSCR. They've really stepped up in a meaningful way. And it's about deploying their dollars in a meaningful way, right? So we talk about, the economics of the transaction. Those life co companies are going to want more of the traditional kind of down the fairway product. So there's a push to originate more of that product and less of kind of the fringe product. But I would say, where they are relative to needing to have them as a meaneful partner is mission critical if you're going to grow and scale in non-QM in today's environment. For
And
sure.
with Dominion, you guys have been, Jack and Fred have been around for how long now? They've been...
Yeah, so Fred Lewis founded the company 22 years ago.
Right. They've been around for a while.
Yeah, Jack Rivera, one of the managing partners, joined the firm 18 years ago.
Right.
Over the course of that, 2 decades plus, have originated more than $4 billion in paper, 14,000 loans in that time as well.
And so now there's kind of an evolution, because when I first met Fred was when I first joined the firm. I went to my first conference on the East Coast, and he was basically like the godfather of hard money in Baltimore. And what today is a very sophisticated business, adding you to the book, adding wholesale to the book. So, and that indicates a lot of commoditization and institutionalization to the product type, because you guys don't do all the food groups, right?
So we're launching the wholesale with a focus on BPL, because that really is the core of Dominion's
but
business.
RTL and DSCR, right?
DSCR and RTL.
Yeah.
And we are going to move swiftly into the consumer space as well, through that whole channel. I've been asked a lot, with Dominion, why now? Like why after 2 decades have they decided to get in wholesale now? And it's because 1 in 3 transactions today is facilitated by a mortgage broker. Right. So when you look at the percentage of mortgage brokers and the impact they've got on the current marketplace, we've not seen a concentration in mortgage broker origination like this since 2009. And so it's why not now, right? So if 1 in 3 deals is going through a broker, that means 1 in 3 deals without being in wholesale, we're not able to deliver our service and product to that customer.
Right.
And our calculus and our hypothesis is it'll continue to increase. So if it's a third of the market today, it could be a half of the market in 3 or 4 years from now.
Right. Is that mostly on the DSCR side, or is it also including the RTL stuff?
It's mostly on the DSCR side, but I think you're going to see some gravitation in RTL as well.
Right.
I also think what you've seen is a set of brokers that have, they might have heard of DSCR, they heard of non-QM, they knew the acronyms, but they didn't really have to learn what it all meant until the agency rates spiked to a 22-year high, and there was panic. And it's like, okay, well, now what? I've got to keep the lights on. I got to pay my bills. I got to keep my LOs with deals coming in. I've spent all this on, direct marketing and lead gen. My real estate agents are looking to me for, how can you help me? And there was this growing opportunity in that business purpose DSCR space. And so one of the big drivers for us is going to be education, right? Getting out in front of the loan officers and the brokers to continue to educate on how best to structure those deals to get those customers set up for success.
I mean, we've heard the same sentiment on the show, actually. Bill Tester said the same thing. John Beecham said the same thing. It's a lot of unknown volume coming from that world.
Yeah.
Untapped.
Yeah.
And that makes sense. We're at our show here, Captivate, before us is Originator Connect, and you see Lima there, you see RCN there. They're all there, so it makes sense. Right?
Yep. Yep.
Please give us more color on the business, product offerings, what you guys are doing on the capital side.
Yeah. Well, I think the common theme, right, is if you're in the agency business, the one thing you're mostly assured of is liquidity. And with the folks sitting at this table, you could wake up and the music could dim dramatically, if not
That's
stop.
the right way to put it, yeah.
and so at least the way that I've approached it is by having a non-bank that uses term financing, and we have a consortium of buyers, Lifeco, alternative investment managers that don't securitize, then obviously the securitizers. But then we also own and operate a bank. And so what I've just noticed over the cycles is that the institutions that were always able to capitalize on dislocation were smart and well-positioned banks because they have a consistent and secure source of funding. We have that at our small little bank, and today there's not tremendous market dislocation. I wouldn't say it's the absolute healthiest I've ever seen it, but it's just fine. But we've all seen it where it's not just fine.
Right.
So that's kind of our hedge, that in moments and in chapters where there's less liquidity, the bank can step in, buy loans, originate loans, and we can keep going. At the non-bank, listen, these are challenges that we all have to contend with. Just because you have term financing, just because you have a wide variety of potential loan buyers does not mean they're necessarily going to be there and step in and step up when those moments happen. So, it's juggling, managing, balancing risk in our line of work, in our niche, is not easy. So I guess the short way of putting it is the bank is really our hedge. And we can push and pull levers. We can de-emphasize a non-bank, emphasize the bank, or vice versa in any given moment in time.
But banks and DSCR get along just fine. They feel like that's a good combination.
Depends on who your regulator is.
That's true.
I don't know if my regional office, OCC office in Cleveland will be watching this. The reality is, we're a relatively new bank. And so new management team, new business model. And whenever that happens, they kind of treat you a bit like a de novo. And so we're in that kind of almost at the end of that 3-year in jail.
The leash is going to come off soon, right?
Yeah, that's the theory. That's our hope. It seems like it's trending in that direction. So to answer your question, we see plenty of banks that are originating DSCR. At present, Community Savings is not. All of our DSCRs originated over at Champions.
The reason I bring it up is because in BPL in general, we saw the first. We saw the first instance of a depository institution, so not an investment bank, but a regular bank, jumping into the BPL sector, and it didn't go so well, right? So, and I'll leave it at that. We already interviewed Bill, and so we don't need to rehash those issues. But it seemed to me that they had more struggles dealing with RTL than the DSCR. They seem more comfortable with DSCR as a product.
Yeah. Listen, a well underwritten product is a well underwritten product. But
is it a lack of understanding of RTL? What do you think? Because I've always been nervous. Are more banks looking at RTL or are they not? I don't know what that looks like.
I'm not aware of banks looking at RTL. I'm definitely aware of banks that kind of the more somewhat down the middle of the fairway, 1 to 4 unit, maybe even up to 5 to 8 unit, DSCR 1 or above, conservative LTVs. But I think for banks, what's nice is you're always trying to match up assets and liabilities. And with consumer, you could see runoff that's hard to predict. You tell me what interest rates will be tomorrow and a year and 2 years from now, then I can model out for you what the CPRs and what the runoff's going to look like. Whereas with business purpose, there's generally an element of prepayment protection. So I think it's a little easier to match up the assets and liabilities with the business purpose.
Right. I ask all of your guys kind of like first exposure into BPL, because they're like, what was your reaction when you first got exposed to it? Because like, I never actually talked to folks that have given me their take on this, because most of the folks that we talk to, and all of our guests on the show, have entered the space. Some have lived and breathed it, but some other folks came from Wall Street in different places, but I never actually asked them this, and I've always wanted to ask folks that did consumer. Like, what were your thoughts when you first heard of BPL as a product offering? What were you doing in your life at the time? And give me your reaction, because it seems it's so divergent, it's so different. And we've built a business around BPL, and so it's like, it's our primary language, if you will. Like, so it's like speaking English to me. I don't have a problem. I have no questions around it. But from a foreign perspective, there had to have been kind of a different take. What was your guys' take?
My take was it served a need.
Okay.
It served a need, right? So, I mean, those of us that, let's say, consumer background or consumer lending background, you had customers acquiring, rental real estate with some consistency, right? It was really the construct of the deal. Mm-hmm. The idea of the property cash flowing on its own merit, the idea of the borrower being an LLC, right? And not a natural person. Like, it wasn't too far outside the box, but what it allowed for is a customer that, wanted to form, which, by the way, we saw more formations of small LLCs, right, post-COVID than I think maybe ever, candidly. The mom and pops that decided to start acquiring real estate because rates are really low and they wanted to acquire some properties and create some wealth in real estate, like Evan had alluded to. So, I mean, for me, it was, how can we deliver a solution out to a growing customer set that, but for us solutioning for this, would likely go to a commercial bank or a commercial lender, and it would be more of a commercial construct in the transaction. And so we talked earlier about how we've seen more brokers out of necessity, when rates hit a 22-year high, have to learn this new area of the business. Those loans are being originated just by commercial lenders, right, and commercial banks. And candidly, I think the idea of it kind of coming into the fold with a much broader broker set, a more residential focused broker set, has been good for business and has been good for consumers and for customers alike. So I think the evolution has been fantastic. So
our kind of giving up assumption from agency was we were just really, it was gut wrenching to scale businesses and then let go a team just because the interest rates pop 50 basis points and just keep doing that. And in my experience, we've never been successful building out teams of loan officers matched with realtors that kind of smooth out that business. So my first impression and the thing we were searching for was just really a non-interest rate volatile lending product. And then somebody tells me about RTL, right?
Who told you about it?
Well, so it was the guys at Pier Street.
Yeah.
Yeah, remember?
Yeah.
And we're sitting at Innovate, and Jason Harris was there. And he's like, you guys have to get into this space. And I'm like, well, tell me a little bit more, just a little bit more, just a little bit more. And at the time, there were 10 and 12 handle kind of, RTL transactions, and Fannie, Freddie, 5.5. And I'm like, there's no way people are selling 12% interest rates.
So it was shock.
Total shock.
Yeah.
Total shock. And I said, and if they are, it's the taking advantage thing, right? It's just
Loan
pure
sharking,
hard money.
Yeah.
To learn that the community underneath that product was primarily a real estate investor, it was shocking, right? And so, I think that word is good. We were shocked when we kind of looked over the fence.
I've heard the same story recently. I was consulting with a client that's opening up a RTL business coming from non-QM, and he was just like, "This is too good to be true. You don't need this. You don't need that." I get an email a day from me. I don't need this, right? I'm like, yeah, you don't. Like, I don't need this, right? No, you don't. Like, does this apply? But no. Like, I get all kinds of questions, and we just laugh internally at the office, like, wow, they're broken over there.
Well, that whole Dodd-Frank thing.
Yeah,
it's a
yeah,
big thing,
yeah,
right?
yeah.
You're an attorney. I mean, the stats.
Well, that's the thing is
and
being an
volumes.
attorney, but that's the thing. I came from the commercial world, right? And so I was a commercial loan originator, and then I became an attorney. But I had worked in commercial my entire life, and so I was used to look at the asset.
Yeah, of course.
Right, but then I come here and
Us consumer guys refer to that as the Wild West.
Right. But like in commercial, we always underwrote the asset. We always underwrote the cash flow of the asset. We never looked at the borrower. We're like, okay, fine, look at the financials.
Sure.
Is he broke or does he have money? But it didn't matter that much in commercial, even at the bank back then. Today, I see a lot of folks that are just like, wow, this is amazing. And they're growing and growing, to your point, because there's an untapped resource. Mm-hmm. And I think that's a really interesting takeaway from today. There's an untapped resource that we're all forgetting about, and it's in the consumer world, which is interesting. How about, what was your first reaction? Because you've been being in non-QM for a long time now, you had to have exposure relatively early on.
Yeah, I guess we've seen kind of the evolution of it being more institutionalized and liquidity grow for it. And I guess my first reaction was, listen, this for the most part is very makes sense, common sense.
Right.
It's a market like anything else, and there's a supply and demand of liquidity and demand for that liquidity, and it certainly seems to me like the investors that ultimately own the paper are getting healthy coupons. The people that are taking on the debt are by and large doing very well, getting leverage against an investment asset that at least over the last, basically ever since the GFC has done nothing but go up. And so everyone so far, I think, it's been healthy participation and it's worked well. And, we'll see where it goes from here. But certainly the way I look at it and the way I look at kind of non-QM in general, because there's been all these different monikers and names for things. Like it used to be hard money, and then non-QM. Some people say, well, isn't that just subprime?
Yeah.
And it's like, well, I guarantee you ask these gentlemen, they'll give you the same answer. When I look at like the average weighted FICO of our book, it's like 740.
Right.
When I look at the average weighted LTV, it's like in the high 60s. When I look at the liquid assets these borrowers have, very healthy. So this doesn't, like back pre-GFC, these would have been like, if there was such thing as 4A paper, it would have been, it was like the best stuff ever underwritten.
Right.
So there's really no, it's not like hard money as I remember it when I was first coming up in the business, because there was so much liquidity out there. It was really low LTV, really low FICO.
Right.
It was like you couldn't it was like, because you didn't have to prove income. No one was really looking at DSCR. It was all asset backed.
Right.
And it seemed like hard money. And maybe you've been in it longer than me, but that's how I remember it. It was the sub 500 FICO, that's hard money. And now, the business purpose loans are the furthest thing away from hard money. Some of these borrowers have 800 FICOs, 40% down, but they can't use personal income, or they choose not to. And so, to me, it's the most healthy when I look at credit, and I just think about where are we today in 2024 from a credit perspective vis-a-vis, 20 years ago. It's just night and day.
Right.
Night and day difference.
But that's the funny thing is I still get this a lot. I get this a lot, these hot takes from people like, oh yeah, like you said, it's still subprime, it's still loan sharking, it's still hard money's got a bad connotation to it. And I've been fighting this. There's been a trend in BPL in general to get away from the terminology hard money lending. And I've always pushed against it because I've always asked myself, well, at the end of the day, we're borrower facing. Our borrowers are the ones that matter, not what we all think amongst each other. We don't need to, tell each other what we're doing out there. We all know what we're doing. But what does the borrower call you, right? And if the borrower calls you a hard money lender, then you're a hard money lender. It doesn't matter to me, right? But are you managing good credit risk? But to that point, there's been an underlying thread in the space for the past year now, I would say 8 months, since January, of credit risk. Credit risk seems to be the number one thing. And the one thing that I really appreciate from the consumer world is you guys understand credit like nobody's business. You understand it. You understand it at its core, whereas a lot of our clients don't. A lot of clients don't even consider it. And so I like to ask you guys, credit risk today compared to even last year, and what are you doing internally to mitigate that risk? Because the number one concern in our sector right now is credit risk and fraud. Everyone's nervous about it. They see it all the time. I'm sure you guys are seeing it. Like, what are you guys personally? Because your perspectives and your experience inform all this, and I think a lot of our listeners can learn from folks that have, you guys, because you guys have such a diversified experience.
So I'd like to go back just a little bit, talking about something that Evan had brought up, because I could not agree more candidly, right? In terms of the quality of the customer that is served by the non-QM and the BPL. Those that associate non-QM with subprime, right? Liar's loans. We've all been in the business a while now. Could not be further from the truth, right? These customers are still meeting some level of ability to repay litmus test on every transaction. Whether it's the property has to cash flow, whether it's the bank statement review and the customer has to cash flow, whether we're depleting assets to make them cash flow.
Right.
The idea of non-QM is serving an underserved customer base that doesn't have the W-2, that can't fit the square box of an agency underwrite.
Right.
It is not about expanding the credit box and creating larger risk or undue risk to give people loans that should not be getting loans. Right? They shouldn't be offered the opportunity or privilege to own a home. They simply can qualify just in a different way, but they clearly cash flow and they can prove they cash flow. So I think those that try to associate non-QM with subprime just don't know enough about what goes into the review and analysis and the credit file in putting a non-QM loan together. I mean, I will say over the course of the last, 12 to 24 months, has credit tightened a little bit? Yes. Is there a little more review on collateral? Yes. Are there certain areas in BPL that have become a little more restrictive? Yes. For example, in mixed use. If that property, has a storefront, a couple years ago, a little more flexibility, kind of more aligned with a multifamily 5 to 8, 5 to 10. Has that taken a bit of a different set of optics in today's underwrite? The answer is yes. I think some of that's a function of kind of where we are as a country with the economy, right? Things start to kind of turn around and there is not the same level of risk that storefront may not have a consistent tenant or that income may not be consistently coming in to help cash flow that transaction. Then maybe it's a different calculus in 12 to 24 months once we get past the election. So that's what I would say as it relates to kind of credit and collateral.
Any takes, guys?
So I was just thinking about your previous question about, you're looking over the fence and you hear 12%. And when Evan brings up subprime, I mean, where I think hard money for me started was you're dealing with subprime files. They didn't, meet credit for some weird reason. And then they had such low LTVs, you gave them hard money loans. Well, even those hard money loans were like 10, 11, 12%. So to look over the fence into RTL and see that's what real estate investors are paying with 800 FICO scores and sometimes 20% down, I couldn't reconcile that to begin with. And I think then following into that next question of credit, if you've been in and around a high volume agency type production environment, that's really all you're talking about all day long is, how do I find a customer that has this profile? How do I read this credit report? How do I understand this asset? How do I understand, even down to you're reviewing tax returns, right? You're trying to understand how does this person generate income and what does the DTI look like? So we spent a lifetime, even if it's been a year or two, deeply involved in the origination of the consumer loan, looking at borrowers, right? And I think hard money or commercial, they're looking at assets.
Correct.
And I think, that's the whole nature of the definition of the business. But it's sort of how you were raised.
Yeah.
And I think I have a little bit of difference of opinion. I think in RTL specifically, there's still a lot of funds. There's still a lot of non-institutional hard money lenders that.
I was about to ask that question. Yeah.
Credit is credit, but I don't need a credit report.
Right.
And I'm not sure they don't make as sophisticated, an underwrite as we do with
Good.
all these other
A
tools.
hot take's finally happening. I love it.
I'm not sure. And I'll tell you, the delinquencies say they do just as good a job as anybody else.
That's been the fascinating kind of evolution in RTL specifically. And DSCR, you can't get away from it. You have to do it because there's no balance sheet strategy for a DSCR loan, right? Everyone's taking it to the secondary. You have to. But in RTL specifically, there is a large swath of the market. And there's no consistency in RTL, I grant you that. There's a large swath of the market that originates a large volume. I have a client in Arizona. He's the number one shop in 4 states. You can't deny that he's doing well. His default rates are below 10%, but he doesn't run credit. He doesn't run appraisals.
Well,
and I've always been stuck in the middle of this debate. I don't know how I feel about it. It's been tough, I'm not
going to put my neck out a widely viewed podcast, but I'll tell you, I think if you pick the denominator that everybody's going to use is delinquencies, every 30, every 60 or whatever, it doesn't have to be foreclosure and the net loss on that asset. As much as us consumer guys will all agree, no matter how you cut your data, FICO is still the number one most important piece.
Best indicator?
100%.
Right.
However, whatever skill or orientation or capabilities these RTL guys have in evaluating true borrower or sponsor credit, even behind an entity and all those things, if the common denominator across all is just delinquencies, they're doing
fine.
They're doing fine.
And one thing that we've been told on the show, and I've been told for years, and I tend to believe is, what's the borrower resume look like? If you're a flipper, especially, what's their borrower resume look like? And if you've got, at least 10 deals under your belt, likelihood of, it's kind of like a FICO score almost, right? And what was the result of those deals?
100%.
Right? But on the flip side, it wasn't until, I would say 16, until we saw this becoming a standard in the space. And in 16, DSCR was not part of the conversation at all. I think it was exclusively done by the non-QM shops at the time. Now you guys, you do RTL. You guys don't do much RTL at all.
We don't do RTL.
Champions. But I still like your perspectives on this. How do you guys reconcile this in the space? For guys who are used to just FICO is king, and then you come to a space and you see this happening. What is your perspective on his take? Because I've been caught in the middle of this, and I don't really know what to say about it because I see both sides to it, and I support my clients that don't. I support my clients that do. And so it's been challenging.
I think in the RTL space, an area of focus has, at least for Dominion, has historically always been strength of sponsor or strength of guarantor. Right? Now, whether that part of the calculus or the entire calculus is FICO score of that sponsor guarantor, there's a lot that goes in. Are they really a seasoned serial investor in real estate, right? And so, maybe they don't have the best credit, but this is their 10th project, 11th project, 12th project. I think a lot of that goes down. How are they managing those projects? Are those projects performing? I think is a large part of the calculus that, again, a more seasoned shop like a Dominion, that's been part of our evaluation since the beginning, right? Less focus on, although I don't disagree that credit, at least in the consumer-facing space, has always been kind of the one great equalizer, right? In the RTL space, it's just so esoteric, right? It's so nuanced that I think a kind of a one snapshot in time relative to how that guarantor may be extended at that moment when they decide to do project 10 or 11 is not the only thing that really drives the decision.
That's true.
Right?
And it's not the only, it's a checkbox item usually. Hey, if I want to sell this loan, I got to check the box on the FICO. I have to have it. Whether FICO score centers change all the time, but it's not like it has to be in a paper where it has to be 7+ or whatever. What are your thoughts? Because you've been exposed to the RTL world. So
again, I probably wouldn't want to speak too specifically about RTL, but more generally, I might disagree that on any transaction, FICO would be what I would look at first, because when we're talking about performance, to me, it's really about minimizing losses. So maybe FICO is a predictor of frequency, but LTV is always going to be the predictor of severity. And so I don't mind so much if there is some frequency. What I don't want is severity. So I guess from my from my seat, the leg of the credit stool that I think is most important is always how much skin there is in the game, looking at the asset.
And talking about like, let's look back on the DSCR side, because, and I have less exposure into DSCR, and for those of you who don't know, I'm primarily a fund attorney. I'm a securities attorney. I just happen to do this because it's kind of fun, right? I was bored
You're a
during COVID.
sick man and you think this is fun. I mean, you say get up in the morning, you're all geeked out.
But on the DSCR world, it's also interesting because the guys in our sector, we hear the ratios. That's kind of the driver, and that seems to be the driver. And then that goes to the valuation question. And there are institutional shops that are pushing leverage on this, and they're pushing leverage pretty aggressively. And there seems to still be a market for it. And the prices are now in a weird place where they're kind of coming down a little bit, and volume is increasing in DSCR. I'd like to get your guys' take. I'm not an expert at DSCR. I know enough to be dangerous, but there seems to be something interesting going on right now. It's August, right? We're heading into the election, like you said. We're hopefully heading toward a rate reduction, but DSCR, I mean, we just interviewed Ben over at Constructive, and he was like, yeah, we had a record month, and we're so excited, and capital's excited, and I have clients that are originating this stuff at a lower price point. Like, what's going on?
Well, that's just a function. When you look at what the LOPAs are with Fannie for investment properties, I mean, now spreads in non-agency for DSCR have come in. So not only have reference rates fallen, but spreads have come in. So now we've almost hit a point where, I mean, I don't know if you guys are seeing the same thing, but there are plenty of instances where the price for someone that deals with tax returns and the whole rigmarole you have to go through to qualify through Fannie Mae, Freddie Mac, through the agencies, the rate price you get there is not too dissimilar. In certain cases, might even be better on the DSCR non-agency side of the house. So as spreads come in on these, because as we know, not all these DSCR loans end up in RMBS securitizations, but a lot do.
Yeah.
And that is a big source of liquidity. And so, spreads have come in. I mean, I think now we're at the AAAs are like what plus 130. I think a Goslow is plus 125.
So you're saying that wasn't a thing before?
Well, it just spreads had really blown out.
Oh, they
increased. So now they've come in and reference rates have fallen. So I think in general, volume's up, right? I mean, whether you're originating agency loans or you're originating DSCR loans, but DSCR specifically, and again, I'm curious if you guys are seeing the same things, but I mean, what we're seeing is that we're absolutely funding DSCR deals in the sixes now. We hadn't ever done that.
Right.
I mean, really since we opened our doors. So I just think that spreads coming in, reference rates falling, it's unlocked a whole new universe of borrowers, but then also some are just choosing to go DSCR rather than deal with Fannie and Freddie, because what's the difference? Maybe you take a 1-year prepay, but I mean, the rate and the terms you're getting are not dissimilar. Right. It's a heck of a lot easier to...
Well, we didn't even see advertisements for any kind of rate pricing for DSCR for a solid, year and a half now. And June, I guess? June, we started seeing advertisements for they're now advertising their rates. I'm like, whoa, what's going on? What's going on, guys? Because everyone complained about pricing in DSCR. And then after those ads started going out, we just saw volume just skyrocket on Lightning Docs. And I was just like, something's up. I mean, I don't know enough, right? I don't know enough of what's going on because we only see we have more insight into kind of the aggregators and the guys that buy from them in our sector. We don't have any line of sight into the agencies. This is news to me. This is great, And
so seeing that, go ahead.
He answered the why for everybody that is tuned into where these bonds trade.
Yeah.
He told you the exact why, but I would just add on that for, to kind of dumb it down for me. But, they're for borrowers, just in the last 30 to 45 days, they've been seeing 6s in front of rates instead of 8s, 9s, and 10s on DSCR loans. And there was the Fannie economist that came out, and he actually gave this huge graph about how many more consumers, borrowers, whether DSCR or agency, would move into the market normalized to a 6 handle on a loan versus a 7, and it was a giant jump. So I think the advertisement, spreads tightening,
Borrower psychology.
it's borrower psychology.
Yeah. Well, that makes sense. You see a 6.98 versus a 7.1, you jump. I don't know why, but you jump. It's not a meaningful difference, but it's,
Well, if you're hell bent on buying, you have a property you think is incredible, you're not likely to do it or not do it based on 50 basis points of interest rate. That said, now where rates are non-agency versus agency, it's tightened so much that now you're probably seeing more go DSCR as opposed to Fannie Freddie, assuming the loan amounts are within those limits. If they had both options, almost always they would say, well, if I qualify for Fannie, then I would take a Fannie loan. Today, interestingly enough, maybe not so much, and it's so much easier, as everyone here would tell you. If I'm a real estate investor and the rate is 25 basis points higher for DSCR than Fannie, I'll pay the 25 basis points just not to deal with, probably, let's be honest, so many not so smart people in our industry. I always call our industry a very low IQ industry. A lot of great people, a lot of scrappy people, but you go from shop to shop, even within a shop, person to person, you're not always getting a uniform underwrite. So God forbid you get the wrong underwriter on a Fannie side. It could be like pulling teeth to get to the finish line, whereas for DSCR, it's really more of a streamlined process.
Right. Actually, a question about that. Are the institutional investors that are not necessarily tied to government agencies, are they reacting to this news? Like you said, are they reacting? Oh, okay, we better get our prices down. We better really take advantage of the opportunity right now. Is that what's going on?
I'm sure Dustin has an answer, but absolutely. Okay. I think the demand for this product at its historic performance levels is, I don't even know if it's 4 or 5, 10 times what the supply is. And I think the borrower community is waking up. Like, wait a second, 6 is, and maybe I'd be curious to know how you think about, if I'm equity trapped, I've got my 2.5% to 3% 30-year fixed, my primary residence. I know I'm not going to leave and go take an 8% Fannie loan, but will I take a 6 or does it need to be 5.5? Like, where does that start to thaw such that we're going to get more transactions even out of the primary residence folks? And I don't know the answer to that.
Well, there's definitely been fatigue, right? Because those that maybe wanted to move up or move just to a different home, different location, perhaps, I think that they were so used to seeing these 2-3% rates. All of a sudden now they're 7-8%. And I think it's probably pretty hard to get your head around that. But once you see it for 2 years straight, and then all of a sudden, any relief, which is now what we're seeing, I think is going to trigger at least a part of the population. And everyone's situation is different, but we talked a little earlier about borrower psychology. Everyone wants a deal. Everyone wants to feel like they're getting a good deal. And so 2 years ago, they wouldn't have felt like they were getting a great deal in the 6s when the rates have been the 2s and the 3s for a bit. But 2 years later, and if their desire is really to move to a different location or move up or whatever the situation may be, any relief at all could be something that triggers action.
Also a sudden realization that, hey, this is not going to get better anytime soon. Because there are a lot of folks waiting.
It took a worldwide pandemic. This is what I always say. It's not just for borrowers, but it's for people in our industry. If you need that market that was there in 20 and 21 on the agency side to succeed, you should exit the business. You're not likely to see that again. And what it's really done for those that are so heavily reliant on rate and term refinances, you might get like a mini run from those that took out new loans in 22 and 23 and into 24. But really, it's almost like an equilibrium where for all that volume to occur in almost a 2-year period, you've really taken a lot of the juice out of, potentially a decade plus of forward originations. And so, and that bleeds down to the borrower, him or herself, where it's like, listen, if you're going to wait for 4% interest rates, 3% interest rates, I mean, you may never see them.
God bless you.
I think that's one of the biggest challenges, admittedly, and I think it was said very well, right? So you look at where rates were at the end of 2020, right? Little history lesson. End of 2020, 30-year fixed, 3.25, 3.35, right? Take a look at where they're at today. We're talking about sixes, okay? There's the positive news, but then there's the math of it as well, right? So if your expectation is you're going to have the buying power that you would have had if you bought a property at the end of 2020, you need to reconcile that quickly because that's not going to happen, right? So if your focus was, I want to live in the $1 million house and have this payment, or the other challenge is the average home price never been higher, right? $398,000, I think, was the most recent number. Right? So now you've got this all-time high sales price, rates that are 2 times where they were in 2020, but candidly, ridiculously artificially low because of what was going on at that time. So there has to be an understanding of what I won't even say the new normal, like the reality is of where rates are going to stay, right? We're not going to be back at 2.875, 3.25. So there has to be a concerted focus on, this is not the new normal, but this is normal, right, in the market. This is what's going to happen. And so you're either going to get on the fence or off the fence, right? You're not going to be sitting around waiting and waiting and waiting because you're not going to see 3 and 3.25 and 3.5 again. And that really is part of the conversation, right? Of those customers that, and whether it's the loan officer not having the conversation, or maybe we're not marketing right to those people to get them off the fence and have a conversation. Like maybe as an industry, we do a better job of like saying, listen, like this is where rates are going to remain. So let's talk about what you can afford today. Like, and as an industry, we could probably do a better job of getting that messaging out. But that's just where things are going to remain. That's where they're going to stay.
That's the challenging part when you say the industry, because this pod is very interesting because the word industry is used now. To me, it feels like a very broad umbrella term now to cover anything residential almost, right? So it's like even mixed use in certain circumstances, and I love it. But here's what I like to ask you guys. This has been a take that we've had consistently over the past 3 years, is that is BPL headed in the direction of non-QM? Is it turning into it? All right,
what does that mean?
Yeah,
what do you
good
mean
question.
by that?
Yeah. So like the best way I can interpret it is, I just had an interview with Ben, right? And from Constructive, and what he said was very telling to me. He's like, I take the perspective of a mortgage banker. If you look at our client base in BPL, for a long time, the vast majority had looked at it more from a commercial perspective. They had taken the position as more of a commercial real estate lending business and taken those precepts and applied it to the industry. They basically they saw what Commercial Bridge had been doing for the years and brought those same practices over to this industry in residential. Since 2016, the advent of the secondary market, really the advent of it was in 2014, but really horsepower in 2016, real seriousness in 2018, a lot of the JVs that were happening, and 2020 just skyrocketed. And so now a lot of folks, especially at the institutional level, are advocating for commoditization. They're advocating for standardization in RTL and construction lending. And so it's in DSCR, I can appreciate there's always been that level of standardization, but what you're saying is that there isn't to some degree, but it's still a minute difference, right? Yeah. In the RTL and the construction lending sector, there's so much fragmentation. And I appreciate it. I actually love it for the creativity. I actually like, hey, you can't get your deal done this way? Well, here's 3 other ways to get it done, right? And I'll walk you through all 3 ways, right? And the question of whether you can execute or not. Today, though, instead of 3 ways, it's become, for a long time, those 3 ways became 2 ways or 1 way. And for a long time, the conversation, the strategies seem to be changing and changing. In the past year or so with rate volatility being so interesting, or 2 years, we've been lucky enough that the clients have been realizing, hey, maybe there's some reality to a balance sheet, but still, this push for commoditization in RTL. And I've been relatively resistant. I'd like to hear your guys' take because you've seen it applied in the consumer world.
So you've pushed my hot buttons,
yeah,
right? Because I ran from that world.
You ran.
I didn't like it. And I think if you bifurcate RTL and you say just this, 12-month paper, and you talk about standardization, it comes down, Evan talked about it earlier, it really comes down from the folks that are financing the aggregators and the investors that are buying this paper, right? However, I'm interested. It's interesting to hear you say that there's been sort of a consolidation to a standard, because I think that space, it's such an art versus science application.
Yeah.
And I hope for the borrower community and the lender community, I would hope that it stays rather artful in the sense that we all get to use our own judgment about, what area we want. Creativity, thank you. We want to lend in, and which borrowers we like, and whether we like ground up or we don't like ground up, and versus, here's an underwriting doctrine. Everyone needs to follow it to get your deal financed, because we'll do, a fix and flip loan at 6.5%.
So in 2020, it was like that. Every week I was getting asked, I need credit matrices from all the buyers. I'm like, guys, have you heard of other strategies before? Like, there's other ways to get this done. Thankfully, after 2020, we got really busy after 2020 because they realized, wait a minute, balance sheet's the way to go with this in conjunction. But it was very mind-numbing for a solid 2 years of I need to know every single credit matrix out there so I can sell everything I possibly can. I'm like, it just feels like we're heading in the wrong direction at the time.
Well, but I mean, I think this is apropos for everything in business purpose lending, but everybody wants an in the fairway loan.
Of course.
Right? But how much of it is there? And then if you say there's 10x more demand, where do you start to create opportunities on the margin? So it's either you create those in our business in rate,
right,
or in product, or in guideline. You have to take your best guess.
Right. I'd agree completely. I mean, I think RTL and business purpose has to stay somewhat bespoke. I think if it doesn't, it's going to become far much less effective as a financing vehicle. Candidly, I really do. So my take is, if it goes the way of agency, you're going to leave a large portion of customers out of the fold. I really do.
Kill the market.
Yeah.
Right?
Yeah.
Evan, any thoughts?
I'm going to yield to my friends here. I guess nothing has to do it. I mean, it's just a market, right? And so usually these things boil down to financing, liquidity, what's acceptable. Which is why, frankly, I will make this point. Whenever I see stupidity in the marketplace, which interestingly enough is pretty often, that provides wonderful opportunities for my bank to portfolio loans, because there's always all the time I see people misunderstand credit risk.
Yeah.
And they'll make these sweeping statements like, we'll never do this. Really? So you mean if these other things were so beautiful and there's all these compensating factors, this one thing it's a hard no. Oh yeah, it's just a hard no because they want it to be uniform. Mm-hmm. So frankly, for me, I like it when the market moves to a more uniform sort of standard, because that allows me to be more creative and say, okay, there's all these opportunities here to serve all these borrowers, and we can balance sheet that.
Right. So you're taking.
So what I've been saying, what you're really saying is we need to stay exposed.
That's the beauty of it, right? But this is the interesting perspective, because for a business that's known to has a reputation for being so standardized, right? You're telling me that, hey, no, we don't want it to be that standardized if we can do it, or be standardized all you damn want, because on the back end here, I'm going to make deals happen and figure it out for people, and they're going to come to me.
I certainly, out of self-interest,
sure,
I would prefer that everything be very standardized.
Because then they're going to come to you.
Right. Well, yeah, just because, and again, like at the bank, it's always about safety and soundness. So it's not like we can be cowboys and make all sorts of crazy loans. It's more, and we see examples of it all the time, whether it's in consumer or business purpose, where the more standardized it gets and the more rigid it gets, the less flexible one can be in just applying common sense. Mm-hmm. And so, it's like when I see, I'm probably not going to think of the greatest example right now, but it may be that there's, we just don't do non-warrantable condos.
Yeah.
Really? Well, okay, we had this one come in. It's like a 50% LTV, borrower's perfect, no non-warrantable condos.
Right.
Okay, great. Well, you don't do that. I'll do that.
Do it all day long.
Yeah. So I know these gentlemen don't want it to be uniform, and frankly, for their businesses, I hope it's not either, because they're smart and they know how they understand credit risk, and they want to be able to apply their own sense of credit risk to files. And if you have the right liquidity and then you can do that. And I would say at Champions, I don't have a structure where I just get to kind of make up my own mind as to what I want to fund and what I don't. There are some swim lanes that, we can push them a little bit, but at the bank where it's like, we get it. Every loan has to be safe and sound, but I don't have to sell it anywhere. I don't have to worry about what someone else's potentially not so smart view of credit is. I get to apply my own
power
view.
balance sheet, guys.
Yeah.
That's so with Champions, any interest in the RTL sector, or is it not?
I just think we want, keep in mind, we've been only at this a couple of years over at Champions. So, and we've been growing pretty quick. I think, this month we'll fund, just a little shy of $200 million. So to do that in a couple of years, it's been a lot of growth. And I think we just want to kind of stay focused on what we know and not try and be everything to everyone. I've just seen so many businesses get in trouble kind of spraying focus all over the place. And because it's not to say they're not wonderful opportunities in RTL. For all I know, I'm really missing the boat. But I think we're just really focused on getting better at how we deliver what we're delivering today.
And that raises an interesting question. In the past 3 years, there have been more non-QM and conventional shops that have jumped into the RTL and BPL sector, right? They just jumped in. Some have added this to their business. Some of them have acquired their way through this and jumped in. Some have tried and failed, and some have made it work, right? And they've done quite well. And, we've interviewed a few, right? Shout out to Keith over at Acura. We're really happy for him when they jumped into the space, and really excited to work with him and his crew. And we've had folks make some headway and trudge along, but we also see some massive failures. What do you guys think is kind of the key to success for a consumer shop breaking into this sector? Because it's a different business. You guys all had your takes when you enter the space, but there's no consistency. I've seen there's no consistency in strategy. First of all, I've had guys come in. They say, "Okay, Kevin, we're going to call you. We're going to do a fund." But other guys say, "Oh, we're going to get this institutional backer to help us go into this space." But there's been no consistency in whether they've been successful or not. And I can't put my thumb on what it is. What is the it factor for the guys that have made it? And you guys have clearly made it. So what do you guys think it is?
Oh, yeah. I'm not sure there's just one formula.
Sure.
A lot of ways to skin the cat. I think we all see a lot of people entering this space. Here's what I would be, if I'm some of these folks, here's what I'd be worried about. One, a lot of these people are not very well capitalized. So it's not going to take much for the lights to be turned off quick. Mm-hmm. They better be damn near perfect, right? So I think it's good. You don't need, tens of millions of capital, and you don't necessarily need a backer if you have enough capital yourself. But some of these folks are getting in with $1 million, $2 million. It's then it's gonna be hard to get, good financing and et cetera, et cetera. And then I don't think some of these shops I don't think they're thinking through, 6 months, 12 months from now. And I get it. They're just trying to get going, but I'm not sure they're really positioning themselves day one for success. And there's just a lot of things you have to think about. And frankly, as you start thinking about them, you realize, well, these are areas where I may need to make some investments, and they may not be in a position to make those investments. So I guess for me, it's one, you got to be reasonably smart. You can't just be oh, the market seems good. This seems to be something I can do. I'm just going to dive in. I originated loans, or I was an AE, or I used to run a company once. Right. And, it's going to take more than that. And you're going to have to work your ass off, and you better be pretty smart, and you better have some capital. And then you better set yourself up for success and not have the margin be so thin that you originate a couple loans that get put back on you and it's game over. And I think some of these places, they're not going to be able to absorb some of these bumps that may be ahead.
That's one of the big things I always tell, you don't have a balance sheet at all, and you're coming in with your conventional or non-QM warehouse line.
Yeah.
That doesn't work here. Like, you can fit like 5% of your line on this product. Like you can't do that here.
I mean, Kevin, there's so many. I mean, I said it earlier. What I love about our industry, one, you generally get people that are really scrappy and resourceful, which is a positive. But then you also get, and again, it's not everyone, certainly not the company that we're enjoying at this table, but you just see a lot of people that are not very bright and short-sighted, and so you just have to, I hate to say it, you just got to let them give it the old college try, and every 1 out of 10 it might work out.
Well, that's why we're doing this show. Right? Part of the
I mean,
reason why we do this show is so that you can learn from people like you.
So we'll talk about RTL as it relates to Dominion. So a little bit different with Dominion because their ethos really was in RTL.
Yeah.
So Dominion Financial Services is a division of the Dominion Group. Under that holding company, Dominion Properties, we're the largest owner of investor real estate in Baltimore County. So we own over 850 properties in Baltimore County. As a holding company, the founders of the company kind of cut their teeth in investor residential. And really they were kind of the pioneers in that RTL, trying to go to local banks, trying to solution for what it is they needed for the short-term dollars to rehab these properties. Couldn't find a solution, and they developed and deployed that solution through Dominion Financial Services, a decade and a half, 2 decades ago. So, I mean, they really cut their teeth in that business, and they understand it very, very well. We also do new construction, so like the management of all those processes is just in Dominion's DNA. Right. And so that's what I would say about how we facilitate RTL.
It also helps to have a nice balance sheet over Dominion. So they do pretty well.
It certainly doesn't hurt. It certainly doesn't hurt.
So if I look at it the other way, so I think, if you look at coming into the business out of agency, and we bifurcate again, RTL and DSCR, boy, it's a very, very difficult orientation coming out of manufacturing a 30-year mortgage, to a term sort of finance agreement RTL thing, and it took us ages.
Right.
And we had all those
clunky as all over for
gosh. Warehouse lines didn't know what you're selling to who, what, how did you?
What is this loan?
Did you mean 12 months as your prepaid interest, or is that the note? And so I think the gateway product, if I was going that way, right? If I was leaving consumer because I'd had it and I wanted to check out BPL, the gateway product's the DSCR loan, right? Get it. You can do it. It's like a Streamline or an Earl or something. You can get your head around it enough to try, and then see if it's something for you, whether it matches up with your warehouse banking philosophies or your balance sheet, or make a smart decision that way. Leaving agency like we did to jump into RTL was foolish.
And we've seen it both at the highest levels and at the local levels, and it's frustrating because you're 100%. I agree with you. I don't think jumping into this space and doing your first starting with a ground construction loan, like, no, please don't. And the challenge has been they've seen it. And I could do that. Like, no, you can't. I'm sorry. You can't.
I thought that was an excellent point. An excellent point you just made. Because what we see all the time are these agency shops, and they're like, well, we're not making any money in agency, so now we'll do non-QM DSCR. And they use the same underwriters that all day long for years have been underwriting Fannie Freddie, which is really an automated underwriting.
Yeah.
And then they get to a product where you do need to dig in. There's not an automated underwriting system. There's tools that can be helpful, but you can't press a button and get a decision.
Yeah.
And so we see this mistake made all the time where these shops, they want to be everything to everyone, and now they're trying to enter into non-QM DSCR. And why do they struggle? And why are their brokers upset and their AEs are upset? Well, I mean, it's not hard to figure out. You have an agency underwriter that maybe they took a class or they did like 1 week of training. I'm sorry, that's not going to get it done.
No.
And so their mindset when they look at that file is the completely wrong mindset to be successful in the businesses that work.
And to make it even more complicated is that there's a secondary market in the sector now, and so they it's like our business. Like, okay, well, I can just do that, right? Like, no, I'm sorry.
No.
It's totally different.
No.
Totally different.
It's all manual. It's all manual.
It has to be manual in our sector. There's no way to make it like that button. There's no button like that in our sector. And people have tried to create the button. Yeah. It doesn't exist, at least in RTL and DSCR. I think it will in the long term. Yeah. It might. But I think you're 100% right. DSCR is your gateway drug. And that's a smart move. And there are plenty of folks here that'll take your loans down.
Well, it's probably not fair for me to name the names. But, the biggest wholesale shops in America now are probably the biggest non-QM because DSCR fits in that bucket.
Correct.
Lenders by volume. You don't even hear about it because it's still a rounding error to them in the origination channel. Again, if it's helpful to anybody, try a DSCR, broker it.
Yeah.
Don't put it on your login.
That raises an interesting question.
Broker it.
To this day, I have a lot of clients that are kind of traditional RTL lenders.
Okay.
They have debt funds, they have other kind of strategies, and they still don't do DSCR. They still don't touch it. And granted, for some of them, it doesn't pencil. Like if they're a construction lender in Austin and San Antonio, it's hard to make that work. I get that. But can you guys educate the audience and our listener, a lot of them are RTL originators and construction loan originators and lenders, like why they should really, and not only why they should do it, but how they can position themselves to successfully transition and add this to their book of business? Because I feel like you're doing your borrower a disservice if you don't help them move on to a DSCR loan, because then you're not only missing out on the economics. I mean, that's great for your business, but like, your borrower is going to find it somewhere else.
Well, not only that, but I mean, it seems like there's kind of like this natural with a lot of borrowers. There's like it's a natural evolution where they had to take some sort of suboptimal financing to fix a project, to finish a project, but then they need something more permanent at the end of it. And what? You're just not going to be there for them at that point?
Right.
It's like, oh, actually, we only did the really messy part of it. Now that everything is in a nice little bow and you're eligible for, longer term permanent financing, we're not going to do that.
So from a borrower service standpoint, it should be
100%. I mean, it's like a natural. I mean, like why just have one bite at the apple?
Correct.
Yeah. So I think to Evan's point, like RTL is a natural directly into the DSCR,
Correct.
right? I mean, it serves that need, right? My short-term fix and flip has now come to term. I've rehabbed the property. Now what? I mean, I want a 30-year AM. I want a longer-term product.
Right.
And that product's now in the sixes. That's it's really attractive. How can I help facilitate that need for that customer versus them finding it somewhere else? And the somewhere else they go may have an RTL platform, right? And so then you lose the opportunity for future business with that investor.
But what's the disconnect? So why are there RTL lenders that say I can't do DSCR, I don't want to do it? Like what's their internal?
Maybe there's an aversion to long-term paper, or maybe they were historically a short-term interim shop for construction, kind of moved into that short-term interim,
I've gotten that.
And they want that constant, churn of those
there's
dollars.
There's the fear, like, I have to paper, I have to hold it. Like, no, you don't.
But again,
you don't.
I think there was a comment made earlier about then broker that first deal, right?
That's the thing.
Don't utilize your warehouse facility.
But that's the thing. Okay, you could easily broker it outside of the house.
Well, it's your deal too. I mean, you have the relationship, so it seems probably a lot of it is either they don't understand it, and hopefully by watching this, they understand that this is not difficult. But and then some of it's just like people just a lot of times they don't get out of their comfort zones. They just do what they've always done, and to I think everyone's point, whether you broker it or whether you're in a position to bank it, you don't have to own this paper long term. There's a large market, at least at present, that there's a lot of demand.
Well, that's the beauty of our space. I think that there's a fundamental understanding that you should never be holding this on your balance sheet. You should be either funding it and selling it or brokering it outside the house. The objection that I've gotten, it's too rudimentary in my eyes. Like, I don't want to lose my borrower relationship. Well, hold on. You've been selling your paper to the secondary. The same systems are in place, aren't they? For those of you guys do this stuff. If the broker, let's call it the broker this time, he's got the RTL on his books and he wants to broker it to you guys, like, are there installations for him to make sure that he can keep his borrower relationship?
But what is that? So I always challenge, what does that mean? I mean, I can only speak, we're certainly not calling the borrower, soliciting anything from them. Now, admittedly, we're probably going to package up a bunch of these loans and sell them into some sort of forward commitment.
Course.
And so I can't promise that somewhere down the road, if the servicer has like some sort of a recapture or retail
Retention,
business, that wouldn't happen. But listen, if it's your customer and you have a relationship with that customer, why do you worry so much about that?
That's a good point.
I mean, just stay in front of your customer.
I think every good wholesale agreement is predicated on non-circumvention,
Yeah.
right? So
Yeah.
I think anybody in this room certainly is not going to be out soliciting somebody else's.
Right.
Right.
But
Agreed.
I was really intrigued. I wanted to answer your last question.
Yeah.
So as difficult an orientation we had jumping out of the packaging and manufacturing of a 30-year, whether it was a Fannie, Freddie, FHA, or VA loan over and over and over again with certain technologies in the back office. We talked about that off camera a little bit. It was so different to put together and assemble, manufacture, whatever you want to but originate an RTL loan. Remember, a lot of your RTL originators, and this is a compliment, they have much of their data on Excel spreadsheets in Outlook or Gmail, and some what I would call non-top 1, 2, or 3 loan origination system softwares, technology out there. So when they look at DSCR, it's like, I don't do that. I've known
So it's just foreign to them.
it's
just so
completely foreign. They don't understand disclosures. They don't
Yeah.
understand all this other stuff that when you're sitting in agency land, it's like, well, can't
way-
do your
it's
first
so much
loan.
easier.
Well, DSCR seems like a reprieve.
Exactly. So I really think
Which
it's,
also makes sense if you see the trends, the guys that come from, kind of like you, like they've come from the conventional world or they were non-QM before this, they have no problem. They all do it. And then the guys that come, either legacy hard money guys or the guys that came from commercial, they have trouble making it. They don't understand it. They're just like, and they're trying to fix it and finish it and do it, but they just can't do it.
and they might not have those tools.
Right.
Right. They might not have places as simple as, it sounds ridiculous, but they might not have the boxes that put in property taxes and insurance.
That's a product
and
of late
HOA.
advent in the space too, right? Because this product was not really in our. I've been at Jurassic now 11 years. It's the second half of my life cycle here at Jurassic. It wasn't the first half, and so it didn't exist. No one did it, and then so the software companies are trying to keep up, and they're adding it. They've been retooling it, but it's just not where it needs to be, I think. And so there will be some sophistication to that for the LOS systems that are in the space.
I think so.
And they're going to improve on it. And I know for a fact, like one of them, I'm really close to one of them. He's telling me, it's foregone conclusion. We're bringing it over. And so that is going to happen. I think that will aid in the process.
Well, that chasm, right, or that gateway drug of the DSCR is going to bring all these worlds together. But I could see if you've had a successful RTL practice and you grew up, whether you got into it, you were a flipper and then you decided to lend to your buddies, or you're just hard money or whatever. It's a rather lucrative practice.
It is.
With a very, very, very reduced back office to anything that's originated in a consumer environment.
So to distill
Think about
everything-
it though, right?
Yeah.
Credit, underwriting, a lot of that stuff, it's a single human being or a couple of people. And we have broken down the manufacturing process from the consumer side into multiple roles, multiple people, multiple milestones in our technology systems. It's a different business, maybe.
No, I like the tape because I always get these calls, new market entries, and I always ask them, like, what's the first deal you've done? And it's always RTL. It's always RTL, and you got the nail on the head because it's what they're used to. But I think one of the things that we should take away is, like, if you are listeners coming from the conventional or non-QM world, do DSCR first as your first taste. It's an easy way to do it.
Broker it.
For sure. For my clients listening that are fund managers, if you're not brokering your RTL out, you should be right now. I get it. If you're in Texas, it's hard. In certain markets, it's hard. Like California is tough too. But it'll come around as there's more stabilization. But I think that it's a first way in. And if you're not doing it, you should be doing it. Your investors will appreciate you for it. Make some more money for your investors.
Well, Kevin, just so those that are listening, because you said Texas and California, it's hard. Are you saying that because it doesn't cash flow?
I think the cap rates are challenging. I think the cash flowing is a problem in California and Texas. Let's dig into this, because I've gotten this as an excuse, but I've also seen clients do it, and I've seen rent rolls, I've seen cap rates there. I'm like, it'll suck, but you can do it. It'll suck for a little bit, and you can do it. Why aren't you? And so you guys tell me what you're.
Well, but I mean, if you're up at like a 10% rate, and now you're trying to help this business purpose investor get into a lower rate. if the equity's there, it doesn't necessarily have to cash flow to get them into a much lower rate. I mean, I'd pump my own company right now, but I guarantee you these guys can absolutely do these deals too. I mean, I think there's a bit of a misconception that the DSCR has to be over 1 to obtain really good financing, probably much more optimal.
So we're breaking this today.
Yeah.
That's the conventional wisdom is that, hey, listen, the rents are just not there. It's just not there. And California is also not a very renter-friendly market. It's very challenging to be a landlord. And so the costs of being a landlord in California are through the roof right now, especially if you're in LA County. And also if you're in Oakland, Alameda County, San Francisco County, it's very, very hard. And so that was one reason. Texas, I actually never understood. I always wondered this. I've heard that this is the case, but I've always wondered, like, you can rent these, right? There's tenants, aren't there? What's the story? What's the reason?
Well, that, and I mean, again, if you're just looking for better financing, the DSCR ratio is just one of the aspects of the credit stool. If they have a good FICO and they have a good LTV, then the DSCR doesn't have to be outstanding. In fact, I'm sure they have the same products. I mean, it doesn't need to cash flow at all, with the view being that, okay, they have enough skin in the game. There's enough at risk here where they're going to work to get to get a renter in to get it to cash flow eventually. But I guess the point being is that I don't know where exactly all these rates are at any given time, meaning today, but I would imagine that someone that with a 70% LTV, 720 FICO, but DSCR is below 1, they're probably still looking at something, in the mid to high 7s. Probably a lot better than the 9,
and
10,
it's not
11.
10.
Yeah,
it's not 10. I mean, Texas is higher than 10, but on the RTL side. But what do you guys take? So I don't know DSCR well enough to know the details as to why people tell me that these don't pencil in these states.
We originate loans in Texas.
Yeah.
I mean, candidly, we, especially in certain markets of Texas, I mean, are pretty damn good markets, candidly, for DSCR.
Yeah.
And again, I kind of go back to that like bespoke solutioning, right? So again, just because your DSCR isn't at 1 or better, doesn't mean there aren't other litmus tests that we put that transaction through to see if it qualifies for financing or refinancing. So, I mean, we do that all the time.
Are there unique challenges in the market that kind of present themselves in Texas?
I mean, there are certain markets in Texas, just like there are certain markets in California. So, for example, Travis County and Austin, it's really appealing to be known as kind of the new Silicon Valley until it's not, right? And so, when that kind of burst, all the kind of the big influx of folks into Austin for Tesla, Apple, sent a lot of the chip manufacturing, and that cooled dramatically, and a lot of folks got displaced. I mean, that's created some challenges here.
That's
I say here, they're locally.
But that's
in the
not
market.
specifically to the point that a lot of my local clients will tell me. It's like, it's just, they always argue that it's so hard to make it pencil. And I was like, let's dig into that a little more.
So I think we could all give our phone numbers. All of your guests here would be happy to do that.
Call these guys.
Yeah, but maybe what they're speaking to, and this is deep in a guideline, is maybe a seasoning thing. Is this like, hey, my guy's done. He's built all this equity.
Could be,
and I can't wait, and I'm coming to term, and should we refinance?
Or maybe they're selling to one investor that I won't mention.
Yeah,
in certain counties in Texas have levied a really punitive LLPA. So maybe that was one of their primary outlets.
I couldn't tell you what the reasonings are. I haven't gotten granular because my role is really more on the corporate and security side and licensing. So, I've actually been wanting to scratch that itch for a while. I think you guys have answered it. Like there are ways to get them done. Don't write the state off.
Absolutely.
Yeah. So, and that seems to be the truth. And actually, we did see some interesting volume changes in the state, and they're very notable. Like, man, the deals are getting done. So, I think our clients are excited about these big markets coming online for
in the traditional Smile states. I mean, investor purchasing in Miami, Jacksonville, even in and around Orlando. I think it's a third of the market. A third of the buyers in those markets are investors acquiring properties.
Top markets for DSCR.
In Houston, Austin, San Antonio, Dallas, we see large concentrations.
Just Austin is the word.
It has its own challenges, although I still love it. I live there. And then again, certain markets in California have been maybe a little more challenging, but again, still huge concentration of investor acquisition in the majority of those cities.
Right.
So if you're not in that space aggressively, you're missing out on what could be a third of the market. So
Well, there you go.
Yeah.
There you go. All right, so I want to transition to kind of some kind of closing stuff. I want to ask you guys, first of all, what's coming for you guys? And we're closing out 2024. I can't believe it's over.
You can't say that.
I know, right?
Just
It's August.
halfway.
Can you believe it's August already? I mean, okay, we're going to be in 2025 in no time. What are you guys focused on for the year, rest of the calendar year, and what's coming for the company that you're at? And tell us what you're excited about.
So thanks for having us.
Of course.
It's great to meet you guys. I think Evan said, staying focused on what you're building and trying to get better. It's kind of our mission statement for 2024. But I think strategically, we're going to launch some new products this year. And that's kind of exciting. But, the bigger the company gets, the harder it is to do those things. And I think everybody's baked it in. But it's interesting watching maybe even the borrower philosophy, but also the investor appetite as everybody is now kind of baking in their algorithms that we're going to start seeing these rates drop. And so that's anybody's guess, but I think most are predicting a really healthy 2024, 2025 mortgage market. And so, that wasn't really the case even in BPL. Came out of COVID, and that was weird for us in BPL.
It was like,
And then we had 2022 again, right?
Yeah.
The tail of 2022. That was really rough.
Yeah.
So, the cycles are certainly shorter, but I think we're excited about some product expansion, but hopefully just an overall great market for everybody: borrowers, lenders, investors.
great.
Yeah.
Well, excited to see some new products from you guys.
Yeah.
Yeah.
Yeah, listen, I appreciate the invite. I've enjoyed
course.
it. I mean, great to meet these fine gentlemen. Great conversation. Hopefully the viewers and the listeners get a lot out of this dialogue. At Dominion, it's really simple. We're excited to launch the wholesale platform. We've historically, our pedigree has been consumer direct, both in RTL and business purpose. I joined the firm about 2 months ago as the president of wholesale to build all things out wholesale. We're going to initially roll out with that focus on business purpose, serving, again, the broker base that is controlling basically at this point a third of the market. A tease a little bit, whether it be the end of this year or first quarter of next year, expand into the broader non-QM product suite, right? With a focus on second home and primary residence, owner-occupied transactions as well.
Big evolution. I
Yeah.
like it. That's
Yeah.
cool.
It's
That's
exciting.
cool.
Very cool.
Yeah.
Well, listen, Kevin, thanks for having all of us, and it's good to be here in my hometown of Las Vegas. I didn't have to drive too far to make this, but appreciate you having us at the beautiful Encore. And I mean, listen, when I sold Pacific Union in 2019, I was forced into retirement at age 40, and I think a lot of people think they want to be retired, and maybe some, in fact, really do. Retirement does not suit me well at all. Just ask my wife, and even my kids. Like, Dad, just get out of the house. And so I've been kind of like a bull in a china shop the last couple years, wanting to build and grow. And I think it's really just continuing to add capacity and always thinking about how do our customers, which are predominantly brokers, some mortgage bankers, but how can we best serve them? Just getting into their heads and speaking with them to really understand how is it that you want to be served, and building all that out. Because just because I think it's great, it doesn't really much matter if our customers don't think it's great. So I think the way we started was with trying to differentiate ourselves with product and mission. But now we've got to continue to, there's some wood to chop with making sure that we are absolutely delighting our customers, 9.8 out of 10 times, because we know we'll never get it exactly right 10 out of 10. But I think that, there's a pretty clear roadmap for us to do that. It's going to take time, but we're working hard at it every day. So I don't think that's necessarily a 2025 thing. I think that's an always thing, and we're just still on that journey.
I love it. Well, I mean, this has been the first meaningful discussion we've had with kind of, people that have one foot in both industries. We've had a few one-on-one, but I haven't gotten the depth that we did today. So I want to thank you guys for giving me this wonderful education too, because I don't know that much in consumer, right? So it's been really nice to talk about kind of the differences and the synergies between the two spaces. For our listeners, I really encourage all of you, if you're interested in starting in BPL, I mean, these guys will answer your phone calls and talk to you. For those of you who aren't doing DSCR just yet, please start doing so. And for all of you who are, seasoned listeners of the show, thank you for listening to this in-person episode while we set up for Captivate 2024. And I'm excited for the rest of the season. Thank you, guys.
Thanks.
Thank you. Thank you.
You've been listening to Lender Lounge with Kevin Kim, brought to you by Gerasi LLP, the nation's largest private lending law firm. Gerasi is the leading legal resource for specialty lenders, asset-based lenders, private lenders, and non-bank institutions. Learn more about the firm at gerasilawfirm.com. That's GERACI lawfirm.com. Check out our episode summary to subscribe to our Lender Lounge newsletter and our law firm newsletter, where you can get notified about new episodes and recent content directly from our expert attorneys. In addition, we'd love if you follow Lender Lounge with Kevin Kim on YouTube, your favorite podcast platform, and on LinkedIn, where you can also check out updates from Gerasi LLP. Thanks for listening, and we'll see you next time on Lender Lounge with Kevin Kim. This is Kevin Kim, signing off.